Okay, well, let me begin by welcoming all of you to our latest edition of Community Capital Live. I'm guessing everyone here is a little bit hungover from their election night festivities, and that's understood. We'll be a little more accommodating. It's also the unusual feeling of not being defeated all the time that maybe will put a little extra energy in all of our steps this morning, my time, and this afternoon for some of you. Community Capital Live is a seminar series that we do every other week, give or take, in order to explore the latest designs in community investment funds. And our goal is not just that you become curious about these designs, but actually that you try these designs out in your own backyard. We practice what you might call BIMBY, which is begin in my backyard. Let me thank the sponsors for today's program. The sponsors are, in part, the Main Street Journal, where I am the publisher and Jen is the editor. We write regularly, weekly, about local investment. And over the next day, we've got a whole new issue about Mayor Mamdani and what he should be doing for local investment in New York. We also have a sponsorship with Neighborhood Economics, with Kevin Jones, one of the co-founders of Neighborhood Economics. They do a regular series of conferences across the year. Kevin, have you folks announced your next conference yet?
We're planning on it in October, and we're in conversations with one of the cities that somebody's at from here, and one in North Carolina, and also one in Georgia. We're in the process of talking to potential host cities.
All right. I'll say, having attended the conference in Chicago a few weeks back, it was so good that there was a line of cities that wanted to say, we're going to host the next one. So put this in your calendar. We also are co-sponsored by Impact Alpha, and Impact Alpha has regular news feeds on impact investing out there. And we are co-sponsored by Amoeba, the American Independent Business Alliance, which represents independent businesses across the United States. So the way that we're going to structure this is I am going to begin by asking a few questions of our guest, who I will introduce in a moment. And then we will get some questions from Kevin Jones, who uh, has a lot of expertise and interesting curiosities about these projects. And then it's up to all of you. And you are welcome to post your questions in the chat as we proceed. But once we get to the Q&A period, I'll probably just call on you to share what you're thinking. So let me introduce today's guest. Today's guest is Ryan Anderson. And Ryan has a very interesting background. He was a urban farmer in Detroit. And I'll say, when I wrote my first book on community economics, Going Local, the most hopeful thing that I saw in the 1990s in community economic development was urban farming in Detroit. It was kind of the unsung way that the city was beginning to come back to life. Ryan has since moved from Detroit to San Francisco, and he is now the chief operating officer of a fund called Steward. And Steward focuses on regenerative agriculture. So, Ryan, welcome to Community Capital Live. But you are muted. Here we go.
There we go. Thank you, Michael. Really excited to be here. Thank you, everybody, for sort of coming out to chat about all of this.
So Ryan, I have a bunch of really general questions to begin our discussion with. And first of all, most people who are gathered here today know what we mean by regenerative agriculture, but I assume there's a couple of people who don't, or they're kind of vague in their mind about what distinguishes regenerative agriculture from, say, organic farming. So how would you define it?
Yeah, organic farming so organic farming is a federal standard that has a set definition of the types of practices that you can and can't use in order to be certified organic. And you can also only use the term organic to apply to products that have gone through that certification process with a third-party certifier. It's really focused pretty exclusively on the sort of agricultural practices that affect the environment. So you're not seeing the use of synthetic chemicals. You're seeing instead use of things like compost. It also is concerned with animal welfare issues. And it's really an excellent standard when you're talking about the environmental impact of a farm operation. Regenerative agriculture for us at Steward, we're really trying to see a bigger picture about the role that agriculture plays in society. So we care about the environmental impacts, and that's sort of our number one motivating focus in a lot of times. But we're also just as concerned with how that farm operation treats its employees and interacts with its own community. Sometimes we like to say it's sort of focused on people, the planet, and the palate, because it also has to be a high quality food. You know, most of the commodity food that's being produced has been bred for, specific traits like a tomato that's hard enough to ship. That not only does that sort of undermine the flavor of that tomato, but it undermines the nutritional value of that tomato. And more, we're sort of seeing that flavor and actual nutritional content are linked in agriculture. And so regenerative, we're trying to sort of change the way food system works more broadly within society, within communities, and how it affects, the health of consumers, as well as the environment.
So Jen has posted the link in the chat to your website, so if people want to take a quick gander at it. I think it's really interesting to about the history. So crowdfunding was legalized in 2012,
Mhm.
and really one of the first and most innovative crowdfund entities out there was called Fundrise. And Fundrise was all about raising capital for real estate. And there was a group of brothers, the
Yeah.
Millers, who were involved in this. So, but one of the brothers decided that he was very interested in regenerative agriculture. So I'm curious the arc of how this story got going.
Yeah, yeah. So, like you said, our founder, Dan Miller, is one of the founders of Fundrise, which is now, funding billions of dollars in real estate across the country. And he and his brother really started that company in Washington, D.C., where they were based. With this idea that they really wanted to help local development and be able to support the revitalization of buildings in areas that weren't getting financial support from traditional funding mechanisms. He loved the work with Fundrise, but also as that company grew, felt like he wanted to do something with even more impact and really get back to his family's roots are on the eastern shore of Maryland in agriculture. And he was sort of looking around after leaving Fundrise, sort of how he could use that skill set and that ability to sort of raise funds online to have an even larger impact. And through some conversations he had in Baltimore, actually, with the chef in Baltimore, Spike Geardy, and one of the local farmers there, Denzel Mitchell, really came to understand how underserved sustainable and regenerative agriculture is in the US. There's a lot of finance that's available to farms, but it's very focused on commodity practices. And as soon as you start to change your agricultural practices to operate outside of that commodity system, it becomes increasingly difficult to access necessary capital to scale those businesses. So he really, from those conversations, created Steward on that foundation.
Do you folks have a geographic focal point, or are you trying to be balanced and reaching all parts of the country?
We are working across the country. We've done loans in 36 states at this point. We do have a little bit of a stronger presence in the Pacific Northwest and along the East Coast sort of foothills of the Appalachian Mountains. And I think in both instances, it's really, commodity agriculture has so much progress in the Midwest taking over those landscapes. And when you've got like big open flat spaces, it's really easy for these highly consolidated and mechanized systems to go in and operate. It's a little bit harder for the commodity system to build farms that are as large in the Pacific Northwest and along the East Coast, where you have a different sort of ecology and you don't have those same wide open fields. And so those are the areas where small scale family farms have held on better, where you're seeing more organic agriculture over the decades, sort of, I think, because of that topography.
So your website says that the loan fund has raised $31 million. Uh, how much of that money has gone out, and how many beneficiaries have received loans? What are the structure of those loans, and what's been the success rate?
Yeah. So there are actually three ways that people can participate in the work that we're doing and the loans that we are originating to farm businesses. The first that you're talking about there on the website that you see, it's called Steward Regenerative Capital. That's a pooled loan fund. And for that product, it's our evergreen product. So if you go to the website any day, it's there. You can lend into that project. You're putting in a 9-month note into that pool of lending. Right now, the rate is 6.5%. And those funds are then used to lend to a basket of different projects. And you'll sort of see on the website, we've got sort of quarterly reporting on sort of what's in that portfolio. That has done about 30 million in lending. All told, we've done over $80 million of lending since the second half of 2020. The rest of the lending that we've done is through the sale of direct participations. So, Steward is not actually offering a fund in a securities sense right now. We are offering non-security debt participations in the loans that we're offering. So, people who are in our lending network on the website, once we have a project that needs to be funded, we'll send out an email to the network and say, okay, this project is coming up tomorrow or the next day. Here's the terms of that, the information about the project. And through our website, people can participate and buy loan participations for as little as $100 into these loans. And so through the sort of non-securities process, we don't have to hit the accredited investor standard. And so we're able to open this up to people in our network at a more, reasonable dollar point for some of those participations. And then all of those lenders are sitting pari passu pro rata in that loan. So we'll have through our platform, people with $100 participation sitting equally next to someone with $1 million participation in the same project.
So are you doing partnerships such that the companies you're lending to do a formal Reg CF raise or a Reg D raise, and then you are just passing that information along to people who are in your network?
No, so this is not Reg CF, Reg D. We're operating under the Reeves test, which was a case in the 80s and then has been sort of reaffirmed by the Kirchner case more recently, where, not all loans are securities. Yes, there are bonds, but there are also loans for real estate, various attributes of lending, short-term commercial paper, for instance, that are not considered securities. And so we're structuring these loans in a way that it's not a security. This is a straight up, debt product. And then the funders who are sort of pulling together capital are just buying a participation of that loan.
Okay, well, I have more questions about the legality on that, but I'm going to pass it on to Kevin for additional questions.
Thanks, and thanks, Ryan. I've listened to several podcasts by Dan, the founder, and I find several things interesting about you. You're kind of a non-extractive lender, and that you don't take the spread.
Yeah.
You have a fee. So like a bank will get 10% and give you 5%, and they will keep it. You don't take the spread, so you're taking less. And I like that about it. I like the fact that you're doing single digit numbers, as Dan once said that, lots of forest projects grow about 8% a year. So if you want nuts, you got to wait till, they have 8 years of growing 8% until you get the non-timber forest products. And you try to be non-extractive like that. There's a lot of things I like about it. And I like the fact that you're doing revenue share when something will pay off after a while, and you can be a little more patient because if you can see that there will be cash flow if you put in that kind of patient capital.
Yeah.
One of the things that Dan said about 3 years ago, is that his real goal was not just to create the thing you're doing, but to create kind of a marketplace where lots of people would use your software. This could be regulated. To what extent has this become kind of a platform where other people can emulate you?
Well, certainly, I think it's a platform that other lenders and people can emulate. And we have conversations with folks on a pretty regular basis about sort of how we're structured, how we are technologically managing the flow of funds in order to regulate that. And, I think one of the sort of key distinctions there is, for all of the loans that we're doing on our platform, we feel such a significant responsibility to the performance of those loans and to the lenders in the network. So it's not a marketplace in the sense that anyone can just show up and put something on our platform
Right.
and sort of at their discretion try to access our network. It is a significant underwriting and diligence process by Steward as the lender of record in order to approve those loans before we raise that from our network. But it's definitely a new approach to sort of raising capital that you could use for other purposes. It could be a local loan fund. You could be doing, other types of real estate transactions. There's definitely a lot of benefit.
And you've built some software. Are you finding people that want to say, okay, you've built that, I can build this on top of it?
We do have folks who reach out from time to time wanting to see if they can sort of white label the software that we've built. And I think that will be coming down the line in the future. I'm hesitant to sort of take our focus off the ball a little bit and start to build versions of the different, tech product for different people when we're still really focused on scaling up the lending business. But we have built a technology platform that's capable of managing the necessary flow of funds when you've got, a couple of hundred different lenders in a single loan through those participations in a way that's really unique and pretty streamlined.
All right. So I'm talking to the COO as opposed to the visionary founder who talked about that on the Kevin Bayou's podcast about 3 years ago. So that's an interesting point. I am often the visionary founder, and my wife, who's the CEO, says, well, that's a really good idea when we finish doing what we're doing. So I hear that. What are you finding about how people get the idea? Pacific Northwest is kind of a good home for regenerative. I'm in North Carolina and Eastern Tennessee and Kentucky. There are a lot of small farms because of the Burley Tobacco Act, which kept farms small with those price supports. And so we have a lot more farm to table size farms that for a place like Asheville, where I live, because there are restaurants there, we're working with a new lending platform, trying to do a food shed approach that we're going to do regenerative, a recoverable grants on. Where are you finding people get the idea? Where do you find you need a deeper education process?
As far as
The idea of regenerative itself,
yeah. North Carolina is fantastic. There are some great regenerative farms. We've got borrowers in North Carolina. My general counsel actually lives in Asheville. We've got former staff who do a lot of work in agriculture based in North Carolina. So after the call, I'm going to connect you with some people so that you can connect into those networks. I think it's really because the smaller farms have been more preserved on the East and West Coast, you've seen more adoption of organic and other sort of improved farming practices. I think another key consideration when you're thinking about commodity production in the Midwest is the economics that a lot of farmers have been trapped into. That's a system that prioritizes certain behaviors and certain actions by those farmers. And it becomes harder and harder for farmers who maybe want to adopt different practices to work that into their farm without losing customers, financial support, access to finance, et cetera. One of the things that I like to remind folks in the regenerative agriculture community as we start to talk about how we're going to transition more acres to improved practices is just the reality of the economics for the average American farmer. The USDA has a really fantastic data series that I recommend everyone take a look at. It's called the Food Dollar Series. It's the Agricultural Research Service puts this out. And they break down for the average dollar spent by American consumers on food, where does that dollar actually go? How much is going to the grocery store or the restaurant? How much goes to the distributor? And how much, critically, goes back to the farm that grew the food? And in the 1960s, that figure peaked at 40 cents of every dollar, making its way back to US farmers. Recently, it's bottomed out at 14 or 15 cents on the dollar. So if you think about that loss of economic resources, every dollar a consumer spends, it used to be 40 cents, now it's 15 cents going back to that farmer. It's becoming harder and harder and harder every year for farmers to make a profit. Over 80% of farm operations have off-farm income, right? This is the polite way of saying 80% of farms aren't profitable. Our food is being grown by businesses that cannot sustain themselves by that operation, and they only stick with it because they're proud of this family tradition and they have a spouse who's working off the farm in order to bring in extra. And so
somebody needs to mute. Oh, there we go.
And so when we think about how we're going to transition acres in the Midwest and get people out of this conventional corn soy rotation, it has to be paired with improving the economic conditions for those farmers and those rural communities. And if you can return more money to farmers, then they will gladly explore ways of changing practices. People aren't stuck in the commodity system because they like it. It's just the reality of what is demanded of them right now. And so we really need to be sending money back to local communities.
Right. I'm from Mississippi, and there was an old farmer that he worked for our print shop, but he was also a farmer. And I asked him what he would do if he won the lottery, because he was always buying tickets. And I suggested that lotteries were just a tax on stupid people. And he said, well, but I said, what would you do if you won? He said, well, I'd farm till the money ran out. Farming was the life he loved. He was a printer because, farmer didn't pay. So in terms of regenerative, it's still a new way of thinking for a lot of folks. And what are you finding are the bullet points that make regenerative work for folks who haven't thought about it?
Again, I think it's really like how this can improve your farm operation. It's really hard to go to somebody and say, you know, US agriculture is harming the environment. And even though you're earning less money every year, we're now going to ask you to bear the cost individually of
Right,
changing that and saving the world. A great example is a project we're working with right now called Green Acres Milling, which is building an oat mill in southern Minnesota. And this is a project where over 130 different farm families have pooled their resources to provide significant equity financing and ownership of this oat mill that's being developed in southern Minnesota. And the farmers who are participating in supplying this mill really, run the spectrum. Some of them are already organic. They're already doing a lot of amazing things on their operations, very environmentally conscious. Others are traditional corn and soy commodity growers. And what they've seen is that because of the way this mill is being structured and the supply chain is being shortened, the mill is going to be able to offer competitive pricing for purchasing those oats. So now they can add to their rotation instead of just do corn and soy, it'll be corn, soy, oats. They'll get a great price for the oats, so their profit per acre will be better than the corn or soy that they're currently growing. When you add the oats and then you follow them with cover cropping, you have a lot more nitrogen retention in that soil. So not only do you not need to add nitrogen to the oats, but you have reduced nitrogen application in subsequent crops in the rotation.
right,
And so their expenses are going down for that purchasing, and you're improving the soil quality and its resiliency for both flood and drought. The farmer who started this project, he was doing conventional corn and soy. And one year, the USDA had this program where if you had a crop that failed, normally you can't plant anything after it and still collect on your crop insurance. You have to leave it bare. If you plant something after the failed crop that is some kind of cash crop, then the USDA says, well, you're not going to collect that insurance because you've got this other product, right? That meant that a lot of times when you had a drought or a flood and people's crops were killed, you just had bare dirt, which is the worst thing you can do environmentally. USDA had a program said, look, you can plant oats. So they had a spring flood, killed, I can't remember soy or coin that year, but killed whatever it was that was in that field. So they planted the oats. And then the next year, 1 year later, there was another heavy rain. Their neighbors' fields flooded, but the field that had had oats the prior year, the soil structure was improved, and so it held more water, and so they
right.
didn't have flooding. And so they actually had fewer losses in that subsequent year because of the oats. And so there are so many economic benefits to improving the health of your soil and your farm operation. And that's really what's bringing in all of these farm families, over 130, right, have actually invested in the mill in order to be suppliers and get that premium price. And that's
Right.
what we need to do with every project all across the country.
That's really interesting. Nicole, are you ready to join? She's another team member that I see has joined late. Are you able to join and chime in?
Kevin, thanks. My internet is a little iffy, so and you guys are doing a great job. There's some good audience questions, but I'll put anything in the chat. I just didn't want to distract if my connection is a little unstable. But great to meet you, Ryan, and I'm really glad to hear more about this organization. It's super
Yeah,
interesting.
great meeting you.
And Ryan, the folks at Blue Ridge Food Shed that we're working with on the recoverable grants, I think will find your approach pretty interesting too. They're
Yeah.
looking at what do in a podcast a couple of years ago, Dan said he was hoping that donor advised funds could be a source for revenue share, patient catalytic money that then could be paid off. Have you found that to be true?
There are a limited number of foundations and donor advised funds that are doing that work. I think that in some ways, those structures are still very slow moving. And what we need is some sort of bold, creative leadership in finance and some action really that needs to start right away, right? Like one of the things that we really appreciate about our lender network is that we are able to move at, at the speed of business, as they say. We can really work with our lenders who are deploying their own individual funds and fund the projects when it needs to happen. Having to sort of go through 6 months or a year of underwriting and conversation
Right.
with traditional institutions, just doesn't serve a lot of these local businesses.
Yeah. Some of the DAF platforms are much quicker than the Foundation PRI kinds of things, for sure.
Yeah.
There are some good questions in the chat if we want to move to that, Michael.
Yeah, let's do that. So we'll just take them in order, and I'm just going to call on you, and you can maybe orally share your questions with Ryan. So let's start with Vince, who is interested in how your products compare with those offered by American Ag Credit. Vince?
Hey, thanks for answering the question here. Yeah, mostly I'm just interested in the sort of material experience of a small farmer who borrows from Steward. What is the application look and feel like, and the experience as a borrower when you compare that to any of the other lenders out there, whether it's American Ag Credit or even smaller CDFAs or CFIs
Yeah.
that might have a focus on ag. I work with farms and ranches, and if I were to direct them towards Steward, I would want to know what it actually is going to look and feel like, and why it would be better for them to maybe consider borrowing through Steward.
Yeah, absolutely. So for the borrower, our underwriting process really has two key components. One is a financial underwriting that you'll see pretty standard across any lender, whether it's us, Ag Credit, a CDFI, et cetera. And we really need to just understand the sort of financial health of the business and the ability of this lending to produce the kind of increased revenue we're looking for in order to facilitate loan repayment. The other part of our underwriting is very much focused on the agricultural practices of that operation. I think one of the big challenges with the sort of farm credit institutions like American Ag Credit are the narrow box that they apply to how agriculture should operate. One of the things that happened with me, I applied to Ag Credit in Michigan when I was farming in Detroit, and the way that they want to structure their analysis of a pro forma is they will only value your crops at the commodity price. So if you are getting a premium price for your product, they will not recognize that. Even if you have, historical performance that indicates, in fact, this is just what you're selling your product for, they won't put that into their pro forma. So you can't improve your practices and then achieve a better price for those improved practices and have farm credit want to support that. So I was growing a lot of carrots on my farm, very popular at the time. We were selling to restaurants in Detroit. We were selling carrots at $4 a pound. We sold every pound that we could ever harvest. We had tons of demand from more restaurants in the region that wanted it. Farm Credit said, carrots are only $1 a pound on the commodity market. So we're going to take your pro forma, and for that line of revenue from carrots, we're cutting it down to just 25%. So of course, like, my farm business would not have survived if we only earned 25% of the revenue. But it was just completely disconnected from the reality of these organizations. So I think for a lot of folks, if you can get funding from Farm Credit, that's fantastic. They have better rates than almost anybody out there. That's great. But for a lot of operators, that's not really a viable option if you're trying to operate outside the box in any way.
Megan, let's go to your question about risk and impact. Maybe lay it out for us.
Hi, sorry, I'm out for a walk. So apologies if the sound is not great. I learned about Steward a couple years ago and was really excited that it's available to non-qualified investors. and you can invest small amounts of money. But I've also like, I guess I haven't had a great, as someone who's not like who doesn't do a ton of investing, I've also had a hard time maybe understanding the risks that are involved. And I've mostly been invested in like the main community pool versus individual campaigns, because that felt a little less risky to me. I was hoping to just talk a little, like maybe at like a simplified level for someone like me, the levels of risk and kind of what happens when a loan borrower defaults, and like how that's dealt with, like the process for kind of dealing with that, and how then borrowers or how the lenders kind of get repaid in that process.
Sure. That's a great question. All loans carry risk, right? And so whether you're lending on Steward's platform or participating in any kind of private credit market, there is risk with that loan, and it could fail to pay you all of the interest you think you're going to get. It could, not return all of your principal. And we want to make sure that all of our lenders understand those risks when they're participating. Over the last 5 years, our loan loss rate has remained below 50 basis points, so half a percentage point of our lending in a loan loss position, which is really fantastic. Typically, CDFIs, banks, et cetera, want to keep that under 2 or 3%. So, through our strength of underwriting and loan servicing, we're able to really keep that in line with sort of industry standards. The way we approach loan servicing is very different than a traditional bank. Some CDFIs work this way. We typically look, our sense is that strong businesses make the best borrowers. And if you're missing a loan payment for any reason, it is likely that business is struggling. We start from the presumption that most of our borrowers want to repay their loan. And if there's a challenge there, we want to address the challenge. So we reach out, we're very hands-on in our loan servicing process to try to help business operators understand why the business isn't performing the way we all thought it would and should be operating. And we will provide, business technical assistance. We'll connect people with agricultural technical assistance. We try to come in and support those improvements and try to shore up that business. Because if it performs well, everybody's happy. That business owner has a successful business. We're getting repaid. It's win-win. If for whatever reason borrowers aren't able to turn things around, if they're not receptive to receiving support and assistance in turning things around, like any lender, we will go through normal sort of loan servicing operations. We will modify loans when it's needed and beneficial. That might mean giving people a couple of months of interest only. Agriculture is very cyclical, so you've got seasonal changes, you've got weather and inclement sort of disaster issues every couple of years. So we're very happy to sort of make modifications for people to get over that hump. And if that's still not doing it, we will foreclose on an operation and pursue liquidation if that's really what's needed in order to recover assets for our lenders. We sort of try to remind our borrowers that we're here for them. We want to support them. Our lender network is issue motivated, and so they really care about agriculture and want to help people. But we also have a responsibility to the lenders, and we're going to do absolutely everything we can to recover their funds and make sure that their financial interests are protected as much as possible.
The next question is from Tiffany Hart of Neighborhood Economics, who is interested in your support for distribution components of the agricultural system. So Tiffany, why don't you elaborate your question a bit?
Yeah, I guess I'm just curious to know if Steward is investing in some of these intermediaries or distribution systems. Something that I'm hearing in the field a lot is that organizations like Cisco have so much efficiency and the scale that they're at, they're able to really build a lot of connections with restaurants, and it's just easy to use an organization like Cisco. So I'm wondering if you guys are investing in distribution systems, or if you've seen others that are doing that. The co-op milling, situation sounds like, that's a really interesting model. And I think that there's obviously opportunities for more cooperatively owned situations to come into play here, but I'm curious to know what you've seen in that space.
Yeah, absolutely. We started out as a company focused on-farm improvements, so purchasing land, equipment, infrastructure for those farm operations. But over the last couple of years, we've really expanded our scope, and now we're working completely throughout the supply chain. We've got lending to, regenerative and organic input manufacturers all the way up to restaurants and CPG brands, and everything in between. And it's just, you can't fund one node of a food system and expect that system to grow and thrive. You really have to be deploying capital at every node possible so that you have that coordinated improvement and expansion of that system. So we love distribution projects. Cooperative structures are great. One of the other sort of projects that we've worked with in Montana is not technically a co-op, which is like a legal structure, but is informally a cooperative of ranchers up in Montana, where, for the longest time, the only market to sell your cattle in Montana were the conventional system auctions and commodity production. So even if you were doing great enhanced practices and keeping your animals on grass for their entire life, and making sure that they get a diverse foliage and have great omega-6 in the beef, didn't matter. Your only market to sell it was that commodity system, and you'd get the commodity price. And they were sick of losing all of the value in the care that they put in their animals in the land by selling into that. And so they've now formed what's called the Old Salt Co-op in Montana, and they have slaughter, processing, 2 restaurants, and a retail butcher shop that are owned by this co-op entity, which is owned by those ranching families. And so now they own every single point along that supply chain. And instead of someone else pulling, 10, 20% out at every step, they're keeping all of that value locally.
Next question was from Scott, and Scott's interested in about the speed of the process. So Scott, why don't you elaborate your question?
Yeah, I was just curious if you could share like what, I think you mentioned some of the underwriting and other processes. I'm very familiar with things that take 6, 9 months, and you kind of inferred that it was quicker. And so I was just following up on that.
Yeah, we can certainly, and we have moved loans in 30 days. In order to do that, the borrower really has to be ready, have everything prepared. It's usually folks who have already taken on equity investments in their project. Maybe they've been through underwriting with another institution that really have the package ready for us to take a look at. But we will move incredibly quickly at Steward in order to make sure that, if you've got a purchase and sale agreement on a piece of property, we don't want you to miss that deadline just because we need more time. That said, 2 to 3 months is a very easy, common sort of timeline for folks. And we will walk people through the process. A lot of people who are great business operators haven't necessarily taken on financing before. And so they don't really understand what it is that needs to be put together in order to make it through an underwriting process. And we don't expect them to be experts in finance. That's our role, not theirs. And so, we'll gladly sort of walk people through, here's what you need to pull together, and go through that process.
So the next question, it is from Nicole, but it really circles back to my question about why you are not a security. So
Yeah.
maybe just take a little more time to explain these legal tests and how you folks arrived at a formulation that you don't need to go through the securities process on this.
Yes. Probably the best starting point, without getting too crazy in the weeds for everybody, is if you look at the Kirchner ruling from the last couple of years. That case is really reiterating, as a first district of New York, is reiterating a test to determine whether a particular financial product is a security or a loan. And that's called the Reeves test. It's based on a case from the 1980s called Reeves versus somebody. I think it was Reeves, JP Morgan. And in that case, the judge sort of outlines, okay, here are the 4 attributes that you need to look at when making a determination whether or not this product is a security or not. It has to do with the structure of itself, the way that it is being distributed, a couple of different sort of attributes there. And we've worked with both internal and outside counsel to sort of structure these in a way that satisfies that standard of the Reeves test in order to not be securities. And so rather than having to limit the participations to accredited investors, which is a securities term, we are limited to sophisticated lenders is the term of art in the Reeves test, which means that in order to participate, you need to have the ability to understand risk and the terms of the loan, understand sort of the participation that you're purchasing, and have the ability and sort of wherewithal to, lose those funds. And so if you join our network on the website and go through and you're participating in the loans that we're originating, you sort of walk through and make those certifications, and we're making sure that everyone participating sort of understands that level of risk and meets the sophisticated lender standard. But it's not like accredited, it's not a financial resources question.
Okay. So there's a multi-pronged question here from John Roy that I won't even attempt to summarize. But why don't you come off mute and maybe ask your top 1 or 2?
Hi there, good evening. Thank you, Ryan, for everything today. I guess I'm just hoping to see. I'm calling from Portugal and working within the European context of regenerative agriculture, and so my organization is looking to map what global stakeholders are doing to promote regenerative agriculture practices, both in practice, both in financing, both in research. So sort of how are you tracking your impact, I guess is my question. Thank you.
Yeah. We have an impact report that just came out for the 2024 year impact report that I think you can access through our website. We are mostly looking at each deal individually. Impact is a difficult question. The most scientifically rigorous standards for measuring impact and biodiversity, soil carbon, et cetera, are also expensive for farms to implement. And acquiring data that I could defensively come out and say, here's exactly sort of the amount of carbon that we've seen sequestered because of our lending would be too expensive for the borrowers. So we instead are really focusing on explaining the practices and impacts of each individual project as we're raising those funds, and then we'll give sort of updates on projects as they move along. So in each loan that you see on our website made available to the lender network, we have what's called a stewardship standard. And this is, we have stewards, principles that exist, and it is a 4-page section in our contract about the regenerative practices that we support, the things that we don't support, and every borrower is contractually obligated to adhere to those principles. But then, because what you see at a, organic input manufacturer versus a restaurant versus a farm are wildly different questions. Each individual project has a stewardship standard where we're sort of bullet pointing, this is, the 2, 3, 4 practices that this operation uses that are why we think we should support them, and they are contractually obligated to maintain those specific practices, for the length of the loan.
I see 2 more questions here, so let's just put them on the table and we'll go quickly. One is another one from Vince about whether you support working capital besides capital to support purchase of equipment, land, farm structures, etc.
That's a great question. We are a secured lender, so we aren't regularly doing significant amounts of working capital. Sometimes it fits in. There's, security for unencumbered assets that people can bring to the table, but we're not typically doing just annual operating lines of credit for farms.
Okay, and the other question, another question from Tiffany was about the mapping of the regenerative universe. I know where I teach at Bard's Green MBA program, a bunch of students have tried doing this. And have you folks used a map, or are you developing a map of your kind of regenerative partners and friends across the country?
We've not developed a map. We're not using a map. It's complicated. I think the TransCap initiative put out a map last year that, in my view, was like the closest to how I would sort of see the different networks. So I would take a look at that.
Great. Well, to wrap up, where can people get more information from you? Do you have a newsletter or other ways that people can pay
Yeah.
closer attention to your work?
If you want to join our network and sort of get all of the news about us, our website is gosteward.org. And I'm happy to answer any questions or chat with people. If you have any follow-up, my email is anderson@gosteward.com. And yeah.
Okay, as everyone, please join me in thanking our guest. I do it with my seal clapping hands here. But it was great information, Ryan. And
Yeah.
Jen, do you want to share any information about our upcoming webinars?
We actually have a little twist. We are taking a step back and in 2 weeks meeting to figure out, what's next for this series. So definitely email me. I'm going to send you the recording and all the links that have been shared, and also ask you a question of like what you would like to see in 2016 around this series.
Great.
Yeah.
Okay. Well, thank you all for coming. Thank you, Ryan, again
Thank
for
you.
sharing
Thank you,
your
Ryan.
information with us.
Yeah. Thank you.
Thanks
This
to
was
Kevin,
fantastic.
Nicole, for your questions, and
Right.
thanks to our sponsors. And whatever we do next, you will all hear about it in your email. So stay tuned. Take care,
Thanks so
all.
much. Thank you. Bye-bye.
Thanks, everybody.